This is really the point it gets interesting now.
Because essentially there's no precedence for a large company like this with a spaghetti bowl of different assets and liabilities and priorities and international bondholders and different kinds of creditors. Who's going to come out of this very happily?
You've got to get rid of these zombie companies. Why would the PRC not use this as a way to be able to get at the developers? Because as long as you have zombie developers, you have no ability to be able to clear the decks here.
Even if the foreign creditors were able to get their hands on these assets, let's say the Chinese court said that they will cooperate with the Hong Kong courts, that these creditors will be way back in line in China, that you would have local governments, you would have the banks, there would be other people who would be ahead of you. But here, one thing that's special in China is that you would have also the suppliers and then the home buyers, because the way that home buyers purchase their apartments is they usually put a prepayment down. So there's just a lot of other people in front of you.
Well, everyone's going to be putting their hand out and saying, what about me? Obviously, we saw that as well, you know, with the coupon payments over this whole process. Dollar bondholders, let's face it, we're probably getting the short end of the stick here. So, and follow through on central government policies to clean up the property mess, because the property mess is leading to the stock market mess.
Welcome back, everyone, to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. Markets in China has W bottomed. Stock and real estate markets in US and Canada to collapse next. Holy smokers, this ain't no jokers. China's second largest property developer, Evergrande, was ordered to liquidate all its assets by a Hong Kong court. What? Your time is valuable, so in this video, I'll be answering why Chinese markets reached its bottom and why Chinese deflation will be imported by the West and causing stock and real estate markets to crash after this last gas state of the wave 5 of 5. So let's jump into this rabbit hole. Evergrande's fall started at the end of 2021.
The new 3 red lines policy led Evergrande to offer major discounts for properties in an attempt to keep the business afloat. As of 2023, Evergrande has reported debts of some $340 billion. Evergrande was declared to be in default in December 2021, facing its largest PR crisis.
那个钱容易吗？我们把我们家所有的财产给两套房都卖了，说在你们恒大买房，他们如果不给我钱，我非得跳楼不行。
Evergrande couldn't reach a deal with its overseas creditors, and so a court in Hong Kong has decided the company should be dissolved. But most of Evergrande's assets are in mainland China. So it's not clear if liquidators will have access to the company's assets.
The U.S. is at record highs in just about all our major indices. China is flirting with global financial crisis lows. Here's what's happening today. In Hong Kong, we have 2.63%. That's what happened today. But let me show you what it looks like over the last 3 years. It's basically from the upper left to the lower right down. This market has been cut in half. And this is actually worse off than the mainland shares. Here's the Shanghai Composite. It's down 23% over a similar period of time year to date. In the upper left, we have the Nikkei 225. That's up 9%, followed by the NASDAQ 100, up 3%. Then we got some other indices. At the very bottom, it's mainly China, and also Korea for that matter, which is highly levered to China. So the Hang Seng down 9.9%, the Chinese, the Shanghai Composite down 7%, $278 billion or 2 trillion yuan, and it's offshore. So they're going to be funneling this money through Hong Kong. But we've seen this chart that I'm showing right now. This is social financing. This is what the Chinese government calls stimulus going back 20 years. This is from the lower left to the upper right, but it just has not had the effect it's had historically recently.
China's stock market is so bad, the government is taking over after Chinese stocks lost $6 trillion in 3 years. The Chinese government is stepping in. Due to the massive loss, the government is trying to crack down on short selling. Short selling is when traders bet on the price of a stock dropping, which seems like free money until now. Because the Hong Kong market has been falling for over 6 years. Hong Kong's major Hang Seng index has fallen over 53%, just like 2008 housing crash. S&P 500 fallen 50%. Well, it has done that. In 2009, it was a great time to buy, right? Yet a lot of bad news still coming out. Like this Evergrande liquidation, which sounds like a finale story of this housing crash, simply because it has all started from Evergrande. Now we get to talk about the US and Canada, the juicy part. If you have any questions, please leave it in the comment section below. I would love to hear some more comments on this video. Thank you. As stock market investors, we cannot afford to be backward looking. The only data that is certain is the charts and data that's already happened. Even some of that gets revised in retrospect. So you really have to be forward looking. It's very difficult to predict the future, right? There are a lot of variables, as we've learned in the last few years. All kinds of crazy things can happen. My job as a risk manager is still to look forward and try and assess probabilities. And so when I look forward at the current state of the world economy, all of the extraneous events that have happened in the past few years, I think that the downturn in the global economy is well overdue. I think we were heading into that in 2019 before you know. We had an expansion that was driven largely by really low interest rates, but there was a lot of consumption growth peaking out. But now I think we've gone back to the longer term pattern, which is a massive amount of consumption and stimulus has now been consumed. And we are heading into the contraction part of the economy. Although the markets have been expressly jubilant at the idea of the Fed cutting cycle starting in 2024, I know from experience, in fact, that's when the bulk of the job loss actually starts to happen. As you approach the cutting and during the recessionary part of the cycle, this is the worst part of the bear market. Losses also happen. Once the Fed starts cutting because they're in response to the slowing economic picture. So I think that's why it's so hard for people to keep their wits about them, to not lose their way with all the noise and flashy stuff that's going on around us. You have to always be looking for what can go wrong, because if you can get that, if you can protect yourself from the losses over time, you're going to prosper better than if you're just chasing the latest trend. For the risk side of the equation, typically during this part of the cycle, when you get into the disappointments in terms of the economic data, and you get revisions and layoffs. In terms of the risk cycle, this is the time when typically equities and commodities and corporate debt all sort of disappoint. Especially this cycle, because as you know, we've come into this with really euphoric pricing. We very much had a double top in terms of the broad markets. 2021 was, as Michael Burry called it, the mother of all bubbles. Now we have passed that high. Now we have a bigger bubble, whether it's the NASDAQ or the S&P, and yes, held up by a handful of big tech names. I remember a very similar pattern again in the 2000 cycle and in the 2008 cycle, where you had that rebound on belief that we were going to get to the end of the easing cycle in cuts. But in fact, it didn't avoid the hard landing because cutting takes just as long to filter through in terms of stimulus or relief as the hiking. So all of that is the reason why people get it wrong or mistake the hiking as if the worst is behind us economically, when in fact it's only just starting now to feel that deflationary pull. Did you know the hiking took 12 to 24 months to start hitting? It's really now coming up with the refinancing, especially in the corporate debt market, especially in households and in places like Canada. You'll notice we've had a lot of layoff announcements in 2024 year to date. The tech sector alone is laid off about 25,000 people, a huge amount of white-collar jobs, and it's across the board right from PayPal to Google. From the finance sector to the tech space, everyone is really cutting back. And these are the highest paying jobs, are really in the line of fire. And what you see at this part of the cycle is that companies become very fixated on how they cut their costs, right? So there's a wall of maturities coming for the corporate sector, who also borrowed a lot of money when interest rates were at all-time lows, under 1% in many cases. Those had terms to them, which are coming up for renewal. This year or next year, the interest rates that they're facing are sometimes 4 and 5% higher than what they had originally borrowed that money at. All at a time when you're already seeing a downturn in the terms of durable goods, spending by households and capital investment by companies. Because companies tend to be terrible at coming into these cycles. They are spending a lot and thinking all is well, when rates are low, when sales are high. They're often underprepared for the downturn, even though it's an absolutely natural reoccurring phenomenon. And it seems to always strike people as an utterly unexpected event. So what they do initially is that they lay people off, and I think that we're going to see that continue. It's quite typical when you get the re-steepening of the yield curve. The 10 two-year spread was 108 basis points wide back in July, and it's now almost actually flat. Now we are likely to see that continue to steepen. That is typically commensurate with this spike and job losses. This is all very textbook stuff that we're starting to see. It's often a boost in terms of stocks that will sometimes rally on the idea that the C-suite is cutting their costs. There's an idea that they'll somehow be able to protect their margins. The consensus right now is still expecting or hoping for the double-digit earnings growth for the S&P looking into the next year. The issue, though, is that sales start to fall more than they can cut costs, and this is where the margin problem comes back. It's one thing to manage your overhead and try to maintain your profit margin if your sales are steady or increasing. But if they start to go down, then it becomes much harder and the sales start to diminish, typically because you're laying off so many people. All these people working in tech start to cut back on their shopping spree. They cannot keep up to their spending at the level that they were during full employment. It's in that next phase when stocks realize that they're priced for perfection. and expecting starting at a ridiculous price to earnings multiples like Meta. And now if we get, as I say, a downdraft, and it's very typical to see earnings come off 20 to 50%, sometimes at this point in the cycle. When the economy starts contracting, then you realize that PE was already rich at 30 times earnings, was actually more like 50 times earnings. And that's when you tend to get a liquidation beginning, and also central banks always cut faster than it took them to hike, right? Once they start cutting, they start to look a little panicked, and that really adds up to the fuel of a negative sentiment spiral like China right now, in terms of people thinking the world is ending.